My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people who make friends just trying to make you some money. My job is not just to entertain, but to educate, teach you, and put this crazy market in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Every quarter, I say the same thing. Do not try to game earnings season. Just step away from the roulette wheel, because if you try to trade around these quarterly reports, you are going to get singed, if not burned. After a record day where the Dow gained 27 points, S&P climbed 0.02%, NASDAQ inched up 0.17%.
That was easy.
You need to understand that earnings season is devastating for traders. If you want to invest in a stock for reports and then buy some more if things go wrong and the stock gets hit, well, that's another thing. But trading, no thanks. Yeah, I didn't always feel this way. At my old hedge fund, I used to place heavy bets on what would happen before it happened. I had as much legal information as I could get my hands on, and I always thought I had an opportunity to make a good call ahead of time. But that was before Regulation FD, when the government leveled the playing field. When I was running money, you could meet with execs in small groups and research analysts and get important information other people simply didn't have access to or weren't privy to. That is now illegal. These days, everyone has access to the same information at the same time. I think that's fabulous. No one should be able to get better intelligence just because they're well connected, better connected than you. However, it does mean that you really can't game earnings season like the pros would back in the 1990s. You have no edge. After I retired from my hedge fund after Regulation FD, I started running a charitable trust. And the trust doesn't trade. We only invest. That's what you should do. It's a trust, for heaven's sake. We can't quick flip. We try to make considered decisions based on the available facts, just like I advise you to do at home. We look at the research, what Wall Street is saying about a company, and if it looks like the consensus is wrong, we might take a larger position in the stock going into earnings. We've had some very good ones for this show, stocks like Chipotle, Honeywell, AMD, Danaher, just to name the recent winners. But it's a fraught process, and I know it. We have whiffed on a Foot Lockers. How about Kohl's, how poorly we did on that? We had thought way too much about Allergan, even though it just got a takeover bid. It's still below where I thought I liked it. We didn't believe that Anadarko would be as terrible as it was. Luckily, we got bailed out on that one by a bidding war between Occidental Petroleum and Chevron. The thing is, you can't count on luck to rescue you from your bad decisions. So with that in mind, let me give you some time-honored rules to help you handle earnings season now that it is just kicking in. First, you need to understand that there are just 12 weeks a year where with just a flood of information. Earnings season. So much information that you simply can't do a decent job of analyzing companies on the fly. I always tell my wife, Lisa, make no plans for earnings season. We even delayed our honeymoon because of earnings season. Admittedly, a suboptimal way to start a marriage. But far from my worst relationship decision, it wasn't as bad, for instance, as trading a big block of Alcoa while my daughter was being born, or trading Union Carbide options the day my mother died. But hey, in the immortal words of Joey Brown at the end of Some Like It Hot, nobody's perfect. The point is, earnings season is important, not as important as your kids or your marriage. Thank heavens, I am learning perspective in my older age, and I'm ashamed about what I did, but I said that when Confessions of a Street Addict came out, and I'm even more ashamed. But look, this season only comes about once every three months, okay? Do you mind if we're doing, once every 4 months, there are 4 quarters, and you got to worry about it all 4 quarters. But when it's over, you can breathe again. So you got these 3 weeks periods, time 4 or 12 weeks that are really dangerous, and they require your undivided attention if you're going to play this game rather than invest. Which brings us to rule 2. You need to listen to the conference calls before you make any decisions. Too often when a company reports, the headlines are written by machines. If a company says it boosts forecasts in the release, the headlines hit the tape and you can get bamboozled quickly. So I need you to exercise some restraint. It happened tonight. We got a headline out of trucking giant J.B. Hunt that it missed estimates. Down with the stock. But then we got a more positive story from the company that mitigated the headline, and the stock zoomed. Well, that's really valuable. I can't tell you how many times I've seen prominent companies like J.P. Morgan, Boeing, Caterpillar, 3M, Oracle trade up and then trade right back down when their quarter, good headline, bad story. If you had an itchy trigger finger on every one of those at one time or another, you got obliterated. There have been conference calls where smack in the middle, we learned that the quarter just announced was the high water mark for the year. That happened on a Caterpillar call. You know the stock still hasn't recovered. If you don't want to take the time to listen to the call, here's an idea. Stop listening to me. Just go buy an index fund. I can't countenance investing in individual stocks unless you're willing to put in the time. Do the homework. Rule 3. Consider where a stock has come from. We know all the bank stocks have been red hot going into earnings, right? That's terrible. Great expectations set the stage for great disappointments. The banks rallied because the government blessed their aggressive dividend and buyback plans. Now we're in the world of cold, hard facts like net interest margins, efficiency ratios, loss ratios, how trading's doing, how investment banking's doing. And that's how Citigroup can report a truly terrific quarter. But because its stock ran up so much in anticipation, they just didn't care. They didn't care what Mike Corbett had to say. The stock ended up in the red. By the same token, if the stock is down going into the quarter, that can create a terrific opportunity. United Health reports on the 18th. If that stock pulls back ahead of its earnings, I think it will be worth owning. Why? Because I expect a terrific quarter from UNH, and the heat these managed care companies were getting from Washington has died down. The CEO, I do not think, will be so emotional and start attacking the system. That was ill-advised. And the president made a major policy shift in favor of the managed care companies against the drugs. At the same time, J&J reports tomorrow, it's down big because of worries about price controls on drugs. That would indeed be disastrous for the whole cohort. But if the stock gets hit again on a monster good quarter, that could be your opportunity. Rule 4, don't be afraid to go against the grain on the stocks of terrific companies, like some of them that I'm going to outline later in the show if you stick with this show. Last week, I told you that because PepsiCo had run into the quarter, there would be skeptical analysts who would try to knock it down, and that's exactly what happened. After trading 134 and change in pre-market, up more than $1, Pepsi plunged to slightly under 131 after the call, where I told you to buy it hand over fist, and now it is back above that one where it reported, because there was nothing wrong with PepsiCo. Nothing. Nice game. Finally, rule number 5, never forget that we live in a time where the S&P 500 can play havoc with any stock. When I got into the business 40 years ago, what mattered most was the company's earnings. Then the sector was in, and then the market as a whole. These days, things have reversed. The market as a whole is more important, then the sector ETFs are more powerful, and then finally, they're the words of a given company. Please, though, understand that's a total blessing. It's what we want. So many people will buy the stock of a company ahead of the quarter and get gobsmacked by big events. Can you imagine if you bought the stock of Merck for the quarter at 87 because the business is good? You're down almost 7% because the president favored managed care companies over drug companies. So understand the frailty of the process. Even if you're right on the company itself, you could be dead wrong on the market or the sector. The bottom line, I do not want you to be discouraged. Earnings season is always rough, which is I prefer bat on the shoulder as my philosophy. Being defensive hitting first. Maybe you get hit by a pitch, or maybe you'll get walked. But the important thing is that you shouldn't try to hit home runs this week because you're much more likely to end up striking out. Bill in Virginia, Bill!
Jim, thank you for all you do for the home gamers, and thank you for actually answering my tweets.
That's exactly what. Oh, well, that's good. I mean, I do answer people's tweets. By the way, I follow my own Twitter. That is not a machine. It be me. What's up?
Down 8% from where I bought it. I'm only down 4% now, thanks to your rule on buying on the way down.
Okay.
With talk of them taking over USAA's wealth management division, if Charles Schwab reports a miss, should I call Uncle, hold, or buy more? No,
I think that Charles Schwab is the most remarkable asset gatherer of our time. It is very undervalued. And I tell you that if it comes down, buy. I don't. Well, that's what happens when you use a bat. Take it off your shoulder. I like it. Oh, I think this could be my old friend, longtime Dave from Illinois. Dave.
Oh, thank you so much, Jim. Jim, this cloud software company has not been singled out as one of your preferred cloud kings, nor as an heir to the throne. Perhaps because this company services a niche market, the life sciences industry. Of course, I'm talking about Viva Systems, up over 100% year to date, perhaps enough to justify its rich forward PE ratio of 75 times. This cloud service provider is a standout for me. And so, Jim, my good mad friend, are you a believer in the Viva?
Not only am I a believer, Dave, in Viva, but I think I totally screwed up. I've had Peter Gasser on the show a number of times. Every time he has delivered far better than expected earnings. And what have I done? I've given only lip service to Viva. I've treated it like Velveeta. It's much better than that. I think you're dead right. How smart are our viewers, especially Dave from Illinois? Viva is a win. All right, I want you to do this. Unless you've got total conviction, here's where your bat should rest during earnings season. Home runs during earnings season are harder to come by. I just don't want you to get discouraged 4 times a year. But don't obliterate things at home because of it. Leave that to me. On Mad Money tonight, we've got a royal on set, and I think it deserves your attention. I'm talking VMware. I'm sitting down with the Cloud King to see what's ahead for the company and maybe a buy. Then I'm bringing you into the minds of big money managers and showing you which stocks will be anointed for the rest of the year. And CNBC's own Carl Quintanilla is going to join me to talk about America's growing but controversial as an e-cigarette addiction. Hey, maybe they're great guys. All they're doing is killing you softly. Sorry. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.